My name's Asad Khan. I'm your moderator. I've got a lovely panel here to talk about stablecoins. I think everyone's favorite subject in the world. In a minute, I'm gonna let them introduce themselves. I'm just gonna frame the conversation here. I like to think of stablecoins as the gateway drug to crypto, maybe the gateway drug to tokenized assets. It's like the first real world asset, the original asset that everyone kind of, I think, gets everyone in trouble and gets everyone into the space, right? And we have a really interesting panel group here. We've got a pretty diverse group of perspectives. We're gonna try to keep it cordial, but we'll make it spicy. We'll make it spicy as well. I got a good panel up here. Stephen, why don't you kick it off with an introduction?
Sure. Thank you so much for having me. I'm Steve Leahy from Circle. I run business developments with a specific mandate to focus on our capital markets clients. I have a background in traditional asset management, what feels like a long, long time ago. Foreign exchange, derivatives, order routing, all that fun stuff. I got into crypto probably 6-ish years ago or so. And yeah, my day job here at Circle is to work with the market makers, the exchange operators, the OTC desks, the asset tokenization firms that are building new use cases that need stablecoins for many reasons that we will be discussing here today.
Hey everyone, I'm Mark Phillips. I'm a co-founder and chef at Steakhouse Financial. We're a boutique crypto-native consulting firm that specializes in financial and consulting services for DAOs and big DeFi protocols. We partner with MakerDAO, LidoDAO, ENSDAO, and a handful of other small projects, including Angle, which is the largest decentralized Euro stablecoin, as well as Venus, which is the second largest protocol on BSC. So we're really passionate about stablecoins and excited to speak and talk to everyone today.
My name is Niklas Kunkel. I'm the founder of Chronicle. Chronicle is an Oracle protocol that currently kind of secures the over $6 billion of AUM in MakerDAO. But we also kind of have half our foot in the real world asset world, where we kind of think of Chronicle as bridging kind of the information gap between traditional finance and DeFi.
I'm Alan. I'm one of the co-founders of Kinto. We are the first fully KYC layer 2 on Ethereum, focused exclusively on compliant financial applications on decentralized rails. Background before that, some DeFi stuff, some market infrastructure execution in crypto, and then before that, doing macro and FX at Bridgewater.
Really interesting group, guys from decentralized finance, from centralized finance, from infrastructure providers. I think everyone in this audience knows what a stablecoin is. I'm going to assume that we're there by now, right? I mean, we've been building for like almost 10 years now. I would hope we know what a stablecoin is. I think the question that's more interesting right now to ask is like, what are the most important problems you guys are solving? This is undoubtedly one of the most important spaces today for the growth of crypto. I think especially for the growth of real world assets. So I think it's interesting to step into your worlds. What is your team looking at as a significant issue that's immediate to you right now that you're working on solving, getting rid of, or reducing the friction that exists there? Start with you, Stephen, we'll work our way across again.
Yeah, so I do agree that stablecoins in general are almost a primitive, right? A digital dollar specifically as unit of account, as medium of exchange. Certainly there are some use cases starting to pop up with stablecoin being a store of value as well. And that's what's going to cause a proliferation, I believe, of different types of stablecoins, whether backed with real world assets, whether algorithmic, we can keep trying those as well. For Circle, the mission of the company is to improve economic prosperity by the frictionless transfer of value. And so we're doing that with, truly a real world asset, dollars, on a blockchain, and it's a simple concept. What's interesting and challenging is, what are those next use cases out there, right? The market fit for a stablecoin as a means by which to speculate and trade on exchanges, move balances back and forth between exchanges was very clear, happened very quickly. Then DeFi showed up, same thing, having a digital dollar as your unit of account and basis of the platform and the yields that you're generating was a very easy market fit. As I look at and as Circle looks at what's next, asset tokenization of non-digital dollars, other types of asset tokenization is critically important. And as someone was speaking earlier on a different panel, when you are building, trading, owning, storing these bearer assets that can move in the blink of an eye permissionlessly, you do need your quote side of that pair has to be something that you can DVP and do an atomic settlement and get the dollar value with an instant settlement such that it's not sitting at a custodian, it's not waiting for someone to tell you that you can have it. So that's what's really interesting to us at Circle at this point in time when it comes to the stable coins is what are the next use cases? How can we make ourselves, weave ourselves into the fabric of all the different assets that are about to be tokenized?
Yeah, atomic settlement, right? With tokenization and real world assets, I think it's a complex question. Credit counterparty risk, operational risk, all that type of things. We'll get to that, I think. But Mark, I'd love to hear your take as well.
Yeah, so the biggest problem that we're focusing on at Steakhouse is that of transparency. We're very, very passionate and believe in radical transparency. You know, we have this open public ledger on the blockchain that is accessible to anyone with an internet connection anywhere in the world. And we believe that everyone that is using a stable coin should have effectively real-time insights into what's backing that stable coin and be able to track it in real time whenever they want. And we've spent a lot of time and resources kind of building out real-time financial statements and real-time monitoring of collateral for the different DeFi protocols we work with. And you know, with Maker, we're really trying to take it to the next level as we get into these different tokenized RWA products. We're trying to bring those on chain and have real-time transparency into every single transaction that occurs between the protocol and what's backing the stablecoin. So without sufficient transparency, you're going to see continued depeggings, continued centralized entities blowing up. And the whole reason I got into crypto was to build something that's more sustainable, less volatile than the current financial infrastructure system. And to do that, I think we need to have such a high level of transparency that risks can be properly identified and mitigated before they spiral out of control, like Terra, 3AC, and all these other CeFi companies that are built on top of blockchain rails. Crypto got such a bad name in the media from these centralized institutions that weren't properly using blockchain, but what no one talked about was how Maker was completely fine after Terra blew up. Aave is completely fine, Compound completely fine. Over collateralization and having real-time access to the collateral backing the stablecoin is critical for trust and transparency. So we want to keep pushing the boundaries there, and we're partnering with Centrifuge on some exciting projects that hopefully we can talk about a little more in the future. But yeah, that's my take.
I'm moderating, so I'm not allowed to share too much of my own perspective, but we'll get to that, I think. But just a quick follow-up, right? Transparency is a big topic. Do you think it's unique to MakerDAO, that like the need for it, decentralized stablecoin, there's an extra urgent sense for having transparency built there? You think it applies across stablecoins?
Permissionless transparency, maybe?
Yeah, we're super bullish on permissionless transparency. And, I was talking to Stephen about this last night. It's like, what level of transparency and trust can we place in existing financial institutions, the big firms on Wall Street? And my take is that like politicians, I think trust is close to an all-time low in the current financial system. And if you have this completely open, permissionless system that anyone in the world can just literally look at open source and audit themselves, see with their own eyes, you can trust the blockchain, I think, much more easily than you can a handful of institutions, which have kind of screwed over the American public over the past few decades. So, and I do think it does apply to centralized stablecoins as well, but given the experimentation going on with, decentralized stablecoins, I think it's even more important that they show, every dollar that's being backed by the stablecoin in real time.
I don't think anything could set Nick up better talking about transparency. Maybe a question over to you.
Yeah, so I think the big problem that Chronicle is trying to solve is making Oracle infrastructure more transparent, but taking it a step further and saying it shouldn't just be transparent, it should be verifiable, right? Can you verify the correctness of the data, right? Can you prove like the provenance of the data? And so can you get away from this model that we have today where Oracle infrastructure is almost kind of like a black box? You can kind of think of it like a fortune teller. It just gives you some data like a vending machine and you either take it or leave it. And this is extremely dangerous, right? Especially in the context in which Oracle protocols are used. where very frequently, right, in DeFi, an Oracle protocol is kind of like the Achilles heel of a protocol. If Oracle ever has like a bad print of data, I mean, in the worst case, some of these like financial protocols could just, blow up and become all insolvent because they start triggering some of these actions based on the data that was given by the Oracle, right? And so in that context, right, it's really important, right, that we ensure not just the correctness, but also just the insight into making these Oracle protocols much more transparent, yes, but also legible. It's not transparent just because it's on a blockchain, right? It also needs to be legible in terms of that anyone should be able to interpret it, not just some senior Solidity lead engineer or some professional analyst at a fund, right, who is like an expert at looking at chain analysis or Nansen, right? It needs to be legible to the layperson, and I think that's kind of the main challenge that Chronicle is trying to solve.
I think that's a great point.
Alan, you got a little bit of a different perspective. You're not a stablecoin, but you're supporting stablecoins, trying to incentivize them to come build on what you're doing. You're thinking about them a lot. What's the biggest problem you see in that space, in that context?
For stablecoins?
Yeah, and like, what are you trying to do to solve that?
I mean, I think that probably the reason stablecoins are so relevant to us is mostly the fact that there are a seemingly large, if you've been in the crypto space for the past 8 years, but like in fact extremely small number of assets in crypto. The vast majority of assets are not in crypto. Those are all denominated in non-crypto currencies. The only way to have them exist on crypto is first to have the primitive of stablecoins so that you can actually do settlement on chain, or else you're not really getting most of the benefit of being on chain. If you have to then take everything back out into dollars to do anything useful with it, then you aren't going to have faster settlement times or any kind of meaningful decentralization of your transactions. So like probably the vast majority of the next 100x in crypto is actually going to be stablecoin denominated. We're doing a largely RWA focused, entirely compliant, financial product focused chain. I imagine almost everything that's on our chain is going to be denominated in stablecoins like USDC. And I think that there's probably an interesting range of trade-offs between centralization and ease of use and compliance within the stablecoin space. I think that most of the stablecoins kind of land in different places on that trade-off. I'm not sure exactly where the right answer is going to be, and I think that probably the right answer is going to change, where probably what is the right answer right now is something like 95% compliance, 5% compliance risk, and then there's some amount of change in regulation that comes and meets that. Although that change in regulation isn't going to happen until much larger pools of capital than retail investors, ideologues, and people who don't have access to other banking systems exist on chain.
So actually, you're kind of getting to my next topic here, right? Which is, Stephen, you mentioned it yourself, USDC, permissionless bearer asset. That is like the principal primitive that you're trying to enable that allows you then to interact with this whole world of innovation that's on chain. Steakhouse and Chronicle both kind of led the wave of DeFi 1.0, right? The blue chip DeFi protocol. Like really the innovation is coming from decentralized finance. And Kinto, you're building a decentralized network. You've kind of briefly mentioned like what you're trying to do is enable stablecoins to come on chain to then allow on-chain primitives to be built. And really, I think you're talking about decentralized primitives, right? Decentralized finance, that whole space of DeFi. Now, we were talking before the panel, you got kind of an interesting perspective on this. Like, I would almost ask, why the hell is it even worth it to build a decentralized network right now? It's such a pain in the ass, especially one that's compliant, that can fit the institutions whenever they do come. Like, why? Reinforce the idea of why it's so important.
Yeah, it's interesting. And if you see a bunch of different panelists here are going to give 100 different answers for 100 different reasons of like why this benefits decentralization. I think having like a holistic answer to that requires a certain perspective, which is like counterintuitive to a lot of people, which is that decentralization is the default. Centralization is a cost. It's a cost that has been paid basically at the birth of a modern financial system because it unlocked a lot of functionality in terms of ease of transaction, capital formation that was impossible to do with decentralization. Like if you were some merchant in the 1700s, you weren't like looking for some banking house to put your money into who might like lose, squander, get it stolen, lend it to somebody bad, etc. But if you're trying to transact from like London to France, and your alternative was basically making a caravan with like some gold and goods on it and putting it across the channel, that had a bunch of delays and risks of its own, and somebody being able to like, do that transaction in a ledger was worth taking a lot of risk. If you were somebody who is in like a town in like the Wild West where like the only two stone structures are like the church and the bank, not for nothing, the fact that the bank put 100x of your entire life savings into the structure makes you way more likely to go put your money there. You don't go to the itinerant bank on the wagon that comes through town and like ask for your life savings. And that's almost like even in the architecture of like what you see how banks are normally built is this sort of implicit trade-off where introducing these costs, introducing this inefficiency is a way for us to mitigate the risks that are inherent to centralization. And most of the development of financial systems is about introducing ways to mitigate that risk. And all of those introductions that mitigate the risk of centralization also create massive costs. This is why, we had some hilarious examples, I think, in like the first panel here of like how many people touch a transaction that should be obviously simple with your custodian, your transfer agent. There's like this broker dealer, et cetera, which in a way is kind of taking a bit of the proxy of decentralization. Like get enough people involved in the transaction, you've like mitigated one bad actor as like a way for all the money to go away. And then obviously if you have all these people, all of a sudden now you need a whole regulatory engine and a whole like, prosecutorial enforcement engine around that and the sort of like big Byzantine bureaucracy. And that helps a lot, and that's done most of what's good in the modern financial system, which probably not true of a lot of people who've been in the crypto space as long as I have. I think is like one of the greatest inventions of humanity. I love central banks, I love our financial system. It's incredible what we've achieved. I think that like ease of capital formation, that ease of transaction has led to most of what's basically good in the modern world, or at least been a prerequisite for it to like incentivize, distribute, and like empower innovation and that kind of thing. But even then, we still have 2008 because when you have these kinds of, regulatory environments, you end up with even further, centralization where you get fewer and fewer actors who can afford to meet these things. And then you kind of have the cycle continue. Then you get Dodd-Frank, and now there's an entire industry of just explaining to people for the cost of millions of dollars of whether or not they're compliant to a law that like nobody understands. And so you have this like kind of self-reinforcing cycle. And the weird thing that happens with that is even when you get something like the internet, those inefficiencies from centralization end up being the mitigating factor where you end up with settlement times that aren't that much faster than they were before the internet, right? Like it is an ease of data transfer. It's like centralization is the constraining factor on efficiency. And so like the reason that that's relevant is both for understanding why you see kind of different kinds of benefits. Like you're interested in the ideological benefits, which I personally subscribe to. I recommend like Eric Voorhees' like keynote speech from last week at Permissionless 2. It was awesome. If you're interested in like the benefits to institutions and stuff, I thought like Ben Foreman's talk, like first thing today, like basically covered those in a pretty comprehensive way. Obviously, the same thing explains some of the benefits you see for folks who don't have access to as good, financial infrastructure, where if all you need is like internet access to access even the kind of relatively capital inefficient, over-collateralized, clunky DeFi that we have now, but that DeFi gives you a better product than a worse, more corrupt financial system that's done a worse job of, introducing the inefficiencies that mitigate the risks of centralization that you would otherwise have access to, you're going to use it. Like the universal thing here is that centralization is a cost, and the main thing that blockchain has done is make it possible for that merchant in the 1700s to atomically simultaneously transport his value to the guy in France and vice versa without having to introduce all the risks of centralization. And this is important not just for like understanding those benefits, but also for like guiding how we develop. Like to the degree that we end up just using private blockchains, we're actually not going to unlock most of the value here because we are not going to actually obviate the need to have all of these inefficiencies and costs that we use to mitigate the risk created by centralization because we're still going to be centralized. And then like that's kind of what we're aiming toward, like here comes the shill, is that you're not going to have, like, one, the ability to create this new financial system that has none of those like efficiencies doesn't necessarily mean we're going to get there, especially not anytime fast. We're going to have like a lot of regulatory things that are going to lag this stuff. For them to make any kind of progress, we have to be able to onboard large pools of capital who aren't going to get so far ahead of regulation that they're going to do things that they just think are like unnecessary compliance risks. So you need to have environments that settle on decentralized rails as a first case and still meet a lot of their needs, like compliance, which is kind of where we sit. Yeah, is that a fair answer? And I also want to say another thing here, like even to the degree that we're going to have regulations, like I don't think that the thing with crypto is going to be a place in which there are no rules. The thing crypto is going to be a place in which the rules are efficiently enforced by smart contracts, right? Like I think we're probably going to automate 90% of what the SEC does away. They aren't going to need to have the enforcement, not going to need to have the investigatory like people that they have. It's going to make them much more efficient. We're still going to need people who are going to make good rules that people want to opt into to create financial systems that they want to use.
Sorry, you mentioned a couple of times, that we are going, and everyone mentioned, and we all agree that we're going to a decentralized world. There's lack of trust in centralized entities for sure. That being said, it's not like, grandma's going to use Etherscan to know who she's sending her coins to. There's still going to be a number of intermediaries, maybe not necessarily centralized intermediaries, but there will have to be layers of providers who take raw information from public blockchains or private blockchains and convert that into, as Niklas was saying, something that's usable and valuable to Jim and Joe retail.
I think actually there's a lot there, right? Like one, I did hear you say I love central banks only at the RWA summit. Where you're a guy building a DeFi protocol actually say that willingly on
We
stage.
should edit that out before.
No,
the
no, no. I
discussion.
caught it. I won't let it go. We're gonna remember that. You can beat him up in
Inflation
the
is
back of the
good.
room later. But Nick, we were talking before this, completely separate topic, but it was something Alan said, which is, if you have decentralization, you have this innovation, you have this ability to create and like execute software that runs with the rules that are enforced, and you don't have to rely on a manual intermediary person to do this, right? Some of the things you've talked about working at Chronicle is about the ability to bring information readily available on chain to like enable that to happen. I would love to hear a little more about that and like why you think that's important, because to me that is what the future of this whole space is going. Using Oracle infrastructure to then create these like automated decisions, right? Maybe we can talk about that within the context of Maker.
Sure, right. Context of Maker here. Some backstory. I was actually part of the founding team of Maker, I think going back, 7 years ago at this point. And I think Mark can kind of fill in some more of the details after me. But Maker is kind of in an interesting spot right now, right? It traditionally had a business of it's going to generate stablecoins backed by crypto, right? Backed by things like ETH, by wrapped BTC, Lido staked ETH. And now, right, there is a change in context, right? And the change in context is that there is this discongruency between yields on-chain, right, and yields in traditional finance, where yields on-chain are driven kind of by the demand for leverage, for speculation in crypto, which is at quite a lull right now, right? And yields off-chain are driven by monetary policy, right? And so most of what Maker has been essentially doing is trying to get access to these, monetary policy-driven rates because allocating within crypto on-chain, right, is not that attractive. Consequently, on the other side, right, you have traditional financial institutions, right, looking for credit, and credit is quite expensive. But here you have DeFi with, basically rates that are significantly lower than anything that's available in traditional finance, right? So you have this kind of like Goldilocks kind of product market fit that's caused by the current context, right? Now, bringing this back to infrastructure, right? This was a very manual type of reallocation, right? There was a lot of people involved, a lot of planning, right? But it doesn't have to be this way, right? We can definitely imagine a future where we say, well, let's just design some rules in terms of how a DeFi protocol, for example, a Maker, right? Let's define some rules in terms of how much risk exposure it wants to take to certain asset classes, or what kind of yield it wants to earn. And then it can make automated decisions, right, based on the flow of information coming in. But again, right, it's the Oracle infrastructure that needs to basically provide this information in a credible way, right? We cannot just say, well, the Oracle says this, and therefore, right, we make some decision, because you've just reintroduced this, the Oracle as like this centralized critical point of failure, right? The challenge is in getting the infrastructure to provide this information in a way that is provably correct, such that the automation, it enables is actually, plus EV instead of just like just adding more risk to the system.
I mean, I love that answer. I mean, Mark, you've been working on that type of thing for a while now, right? I'm curious if you had anything to add there.
Yeah, I got into MakerDAO originally because I always believed that stablecoins would be critically important to cryptocurrency. I got into Bitcoin in 2013, and it was basically written as a peer-to-peer cash, digital cash. And as it got more and more popular, I realized how impractical it was, especially when the block wars happened, circa like 2015, 2016. And then I learned about MakerDAO, and I kind of had heard that Andreessen Horowitz invested into it. And I was like, well, that's super interesting. There's this like 2-token system where you can have stability Maker can kind of control the interest rates up and down, and that can kind of help stabilize DAI around like the $1 peg. And since then, like Maker has gotten so much more complicated and sophisticated, and it's been quite a ride. But the journey, and Asad's been quite close to that. So
quite a ride is an understatement, but it's another panel later on in the after party for what the story of Maker.
That's an after party panel with alcohol, but I think Maker realized quite early on in 2020, 2021 that the way to scale a decentralized stablecoin would require going into off-chain assets. And that was an extremely controversial topic at the time. A lot of the early engineers at MakerDAO believed in this, fully on-chain, fully decentralized system. And, it kind of became a question of idealism versus growth. And growth ended up winning out in the DAO, and thus kind of began MakerDAO's venture into RWAs. And at that moment in time, the incentive was actually quite low to do it too, because interest rates were pretty much at zero on the short end. And the cost of onboarding these sorts of private credit deals was extremely complex and costly. Maker effectively knew that they would lose money on all these deals, but that we would learn a ton and hopefully move the ball forward for the industry collectively with Centrifuge. Fast forward to 9 months ago, we're now in a much higher interest rate environment, especially on the short end of the curve. So it's much more attractive to make these sorts of off-chain investments and actually start to earn yield. And we have a variety of partnerships with some of the other stablecoin operators, and this sort of like business model where you can have all this excess demand for your stablecoin and kind of put it into these off-chain assets like treasuries. Like the 6 month is yielding 5.5% last time I checked. It's pretty attractive. And DAI got to a point where, especially in a bear market, there's so much excess demand for DAI. Before we would raise interest rates, so borrowers would pay back their DAI, or we would lower interest rates to spur demand and decrease the price, so more and more people would mint DAI. But today we basically just take the excess demand for DAI and stick it into treasuries to earn yield. That's pretty much it.
No, it's just that simple. It's that simple. Take the excess demand and just stick it into yield. Mark Phillips, right? Yeah. I actually think it's really funny, like going back now, kind of covering the spectrum of what we just talked about. Importance of innovation, importance of financial market infrastructure, something we talked about a lot. Like the importance of verified information, transparency, bringing data on chain. And then, Mark, you're kind of on the operator level of this, right? At a level like maybe above, like between the meat space and the data space, right? It's really like stablecoins are this asset management business combined with this balance sheet management business, combined with this product and instrument and infrastructure business, right? Stephen, you've been around the block. I don't think you mind me saying that, right? There's a lot of lessons to be learned here, but it's a whole new way of doing it, right? I think for so long, the challenge has been getting people in crypto to see what they could realize from traditional finance and bring that into the industry. I don't think we're having that problem anymore. I think this kind of summit is really exemplary of how the two industries are converging much more. But I'm curious to get your take. You've been working at Circle for a little while now. What are the things from TradFi that we need to be bringing more of into this industry, or that you think we could benefit from more of moving forward?
Interesting, good question. So what could we bring into the industry? Certainly, I spend a lot of my time still working with the OTC desk market makers, kind of what I call fast money. I feel like we do have infrastructure for prime brokerage, but we don't necessarily have the full package yet. There's a couple companies working on it. There's not much credit yet. It's interesting because with bearer assets, that makes things very different when you want to settle on, as far as like trading and settlement, net settlement, clearing. I think there's still a lot of innovation or change that's going to happen within the back office side of capital markets of digital assets for sure. When it comes to real world assets though, and the tokenization and taking title and claim to something that's a real world, physical, tangible object and moving that on chain. I mentioned earlier, I firmly believe that because these are bearer instruments, one needs to be able to settle any trade atomically or effectively DVP. no doubt about that. I think it's interesting because there's been a lot of talk about trust and transparency up here on this panel. Right, Circle being a centralized actor, one of our core tenets is transparency and regulatory compliance. And so it's interesting, you know, we do our darndest. We have a massive team that works very hard on transparency, from making sure that our partners at BlackRock who are running the reserve portfolio are publishing, like down to the QSIP, which assets are held in there with an actual ticker. You can go look up on some stock things like USDXX. But I do think that even us at Circle, like, we have a ways to go with transparency. We, you know, there are, in the traditional world, you would never show what cash is in your bank account. That's your business, right? But if you're running a stablecoin and we want to transparently show what assets are backed in the stablecoin, you know, maybe there's more that we could do as far as with our banking partners, the ability to show. And so Circle continues to work on improving and increasing the transparency of everything we do at Circle. Again, it's kind of like one of our core tenets there, but it'd be interesting because to me, oftentimes when I get a ping from someone who I know or like, you know, in TradFi who are like, hey, I'm interested in crypto, and by the way, there's a lot less of those now than there was a year and a half ago, right? There's not that many people who come from the back office necessarily. There's a lot of salespeople, nothing wrong with salespeople, I'm a salesperson, right? But there's a lot of people who want to move over from that side of the house. And the first thing that I always ask people is like, okay, do you understand how ops work? Because really, what digital assets and the use of public blockchains, or again, private blockchains, it means that you can change up the way operations work for financial services firms. You can change the pipes in the background of how one confirms, settles, moves value. And so I actually think that there will continue to be, especially in the real world asset space, and maybe this is a topic for the post party, like social lubricant conversation, but there's definitely going to be a lot of improvement, I think, within real world assets about how one is able to take real world assets that are on maybe chain A and maybe on exchange and trading on exchange Z, and we should be able to view those in a multi-chain way and maybe even across different platforms with all the settlement taking place in the background fairly simply. I shouldn't say simply because it's complex, but easily. There should be a solution for that. So I do expect, and I certainly hope, and maybe spend some time thinking about that myself.
I love that. I appreciate a little self-reflection on what Circle could do better and where you think things are going. This is not how the panel is supposed to be run, but I'm going to open the crowd to be questions. You're going to have to shout, so make sure you're willing to shout your question. I'll repeat it, and I've got a pick here, so all my friends in the audience, if you have a question, raise your hand. Or anyone has a question? All right, this man, I don't know this guy, but. You're talking about DAO treasuries, right? So do you see DAO treasuries as an issuer of stablecoins?
I think unlikely. I think stablecoins are an extremely competitive business and extremely difficult to do, especially if you're a decentralized stablecoin issuer. The advantages that these centralized stablecoin issuers have, which is primarily cash redeemability and capital efficiency, are just an extremely tough challenge to overcome if you're trying to operate a decentralized stablecoin. You know, people are trying some Ponzi-nomic things, like obviously we saw with Terra, that just flat out like aren't going to work. And I think some of the stablecoin regulations coming are going to, you know, put a damper on some of those kind of extremely experimental ideas. And I kind of tend to think that this market will consolidate around a few winners longer term. I think it's going to be really tough for these newer stablecoins to get significant traction, just because if you're operating your own DeFi protocol, you know, you want to integrate the stablecoins that people use, that people trade, that people trust.
Network effect.
Yeah, the network effects are just extremely strong for these products, and it's really tough. And really, the true like sign of stablecoin success is like organic demand for the stablecoin. Like you can throw liquidity mining rewards on top of your stablecoin, like Frax is attempting to do. But if you don't have any actual organic real demand for like to use your stablecoin, then your protocol is not going to make any money off of it. So I think it's going to be a huge challenge for these new up-and-coming.
Sure. I mean, you're even seeing like established players, right? Like you saw stablecoin launches from Aave, right? You saw stablecoin launches from Curve. Very powerful players in their own right? In the DEX space and in the kind of money market space. And just utterly incapable of generating any organic demand, right, for their stablecoins, right? So it's this organic demand component, right, that Mark brought up, right, is extremely important and also extremely difficult, right? So I do tend to agree with his view, that there's going to be considerable degree of kind of like stablecoin consolidation rather than expansion.
Any more questions? Don't be shy. My man Harvey.
Do you think tokenized money market fund, right? If you have a token and then it's accruing yield, is that better than just stablecoin? And if so, what are the biggest hurdles to the adoption of such an instrument?
I'll first crack, if I may. I think certainly there's going to be proliferation, and we're seeing it already, of tokenized money market funds. It's a pretty easy kill. And that's great as a savings account, effectively, in my mind. That being said, because most of those who will be issuing tokenized money market funds have some form of whitelisting or accreditation to their end users at this point in time, especially here in the US, you can't use it then broadly as a medium of exchange. So that's the challenge, right? I get the, the Franklin Templeton money market fund. I have access because I'm accredited. I want to go move it around or use it collateral for somewhere. And I want to use it for collateral at your custodian, but your custodian doesn't have an account with Templeton. You haven't been KYC'd. Your wallet address is not whitelisted. And so therefore I can't use it for that manner. So tokenized money market funds, again, to me, in the short term, great savings vehicle. I think there'll be a massive proliferation of them. I think it will be in the tens of billions by this time next year. But I don't think that takes the place of a stablecoin for use as medium of exchange.
I can weigh in on this one as well. Yeah, I think at the high level point there is once you start passing on yield from treasuries to somebody, it's really difficult not to be considered security. Once you're security, it's really difficult to have yourself be transferable freely. There are a couple, mitigating things around this. There are places like, or there are protocols like Mountain Protocol that are trying to do this restricted to jurisdictions that don't have those kinds of constraints. There are potential models where you do something kind of like Maker, but issue a stablecoin against only treasuries, where you own the collateral, which is the treasury, and separately gain like a medium that you can use for transaction, et cetera. And there's also like, this is sort of exactly the world in which we operate, which is even if you have something like that with those constraints, once you have a chain on which you can have the actual contract of the token check who the recipient of a transfer is, and if that person is non-accredited, whatever the relevant constraints are, what jurisdiction there is, then revert the transfer, then you can get basically as much freedom of movement as you can within whatever compliance constraints you enforce, without having to individually, as your own protocol, do all the whitelisting, et cetera.
I love it. I love it. Unfortunately, we have to wrap it up. I think this is a great panel. I hope everyone enjoyed it. Give a round of applause to our panelists. Thank you very much.